When we talk about interest rates, there are lots of ways we go about figuring out what an interest rate should be. And if we are playing smart, then there are lots of factors that go into that decision. The borrower's credit rating, the term of the loan. Those are the two major ones when I think about setting a loan interest rate. When I think about how much am I going to charge you? Do I expect you to pay me back? What's my risk factor calculation? In some financial instrument, the investor has the same concern. Back in chapter 1, we talked about this, how government policy can decide on what primary interest rates are, what corporate interest rates should be, what I believe is going to happen. So one of the things we're going to look at is the relationship between term or time to maturity and the yield rate. For a fixed income security, something like a bond, something like a straightforward annuity, something that gives me the same payment. The relationship here is called the term structure of interest rates. And if we think about the graph of this as a graph of yield over time, I'll get some graph here. We're going to call that the yield curve. Now, term structure changes based on economic conditions. So as the economy grows or shrinks, as businesses do well or poorly, as the government does stuff, this picture is going to change. Usually, what do you expect? Well, I expect a longer term investment to have a higher yield. We're going to call a graph that looks like this, a yield curve like this, a normal yield curve, a normal term structure. What should the picture look like in this case? What would you expect to see if this is our structure in this picture up here? Say what? I'm not sure about linear, but it should definitely be a positive slope as we go from left to right. So I would expect a curve that does this. Something that increases. The longer my term structure is, the further out I'm projecting, the higher my yield should be. Okay, why is this, quote, normal? Why would it make sense for you to get a higher yield on a longer term investment? You're loaning me money. If you were going to loan me for money for a week, would you be put out a whole lot? So you're loaning me $100 for a week? All right. If I've got $100 to loan, that's not a big deal. But if you're loaning me money for a year, then you're without that money for the whole year. I have it. You don't. The longer time you don't have the money, the more lost opportunity you have. Well, you should get paid for that loss, right? Somebody, me, the person you loaned the money to, should reimburse you for the fact that you didn't have this money for a whole year. The longer you don't have it, the more I should pay you for it. So a longer term should correlate to a higher yield. However, it is possible that this gets screwed up. Page 282 has a table with a bunch of treasury notes on it. Now, please notice this is not a linear time scale. Right here, we've got bonds from the treasury that mature in a month, 3 months, 6 months, and then we start looking at years. 1, 2, 3, 5, 7, 10, 20, 30. It's not linear across the x-axis. So my graph's going to look weird because it won't look like a straight line, because I will have had this weird scale on the x-axis. And then there are yield rates here. 2013, 4.75. Ooh, interesting. 10-year notes are low. That's 2023. 2013, the 1-month yield was very low. The 30-year was much higher. This structure, 2013, looks right. Short-term yield is low, middle-term yield is higher, longer-term yield is highest. This column represents a normal term structure. In 2017, I see the same thing. 2022, my base rates are much higher. But there's this weird sort of flicker here in the middle. But look at 23 and here. What's going on? Short-term rates are high. Long-term rates are lower. There's a graph of this on the next page, which pisses me off because it's in black and white, and I have no way of knowing which picture is which. So I went and printed a color version. This is the picture, top of page 283. The red curve at the bottom here, that's the 2013 curve. This curve right here represents rates in 2013. It's increasing, right? As I go from left to right, that's going up. But you see how the gap here, this is a 1-month rate, a 3-month rate. The gap here is the same as the gap between 10-year and 20-year. So it's not a good x-axis. The marks are all wrong. They should be much more compressed on the left than they are on the right. This is what is referred to as a semi-logarithmic scale because these numbers are screwed up. These are still in percentage yield. But the 2023 curves that I was talking about, that's these blue and green curves. The 2022 curve is in this kind of yellowish color here. What the hell's going on? What changed between 2013 and 2022. Something important changed. I mean, 2022 here is mostly okay. Term structures start out low, they go up slowly over time, and there's a little fluctuation at the end. But for the most part, we're going up as we go from left to right. These aren't. 2023, something weird happened. We're going to call this picture, by the way, an inverted yield curve or an inverted term structure. Short-term rates are higher than long-term rates. What does this indicate in the market? Why would you do this? Remember, these rates are set by people who are deciding what rate to charge people for their loans. In this case, it's the US federal government saying short-term loans are going to give you a lot of yield, longer-term loans are not going to give you as much of a yield. Why would you do something like that?
You don't think rates are gonna stay?
You don't think rates are going to, so why would, again, why would rates change? You get to set the rates. I think it's actually the other way around. I'm not worried about the rate, I'm worried about the money. Up here, people are holding on to their money tightly. And so if you want to borrow money, you want to get an incentive for people to give you money, you need to pay them. You need to raise the rate you're going to pay them for them to loan you money. So in this case, that's what a bond is, right? You buy a bond so that they'll pay you the coupons. You buy a bond so they'll give you the interest. You loan the money to earn the interest back. People don't want to loan money. You raise the rate you pay them so they're more likely to loan you money. This indicates you're less worried about the money in the long term than you are in the short term. Your need right now is bigger to borrow money, so you'll pay more for it. Nobody's 100% sure about what causes an inversion in rates. People seem to think it indicates lower confidence in the long term. You're worried, I'm not sure they're going to be around long enough to pay me back, or I really need the money more right now. By the way, in this particular case, it's related to the fluctuating market conditions after the pandemic. 2023, we were still recovering. 2022, we were starting to settle, but 2013 was well before the pandemic and everything was hunky-dory in the market at that point. So there's a substantial difference. I'm going to be concerned with yield curves and how they change my pricing. Because if I'm buying a bond or a whole collection in a portfolio, I got to look at all the terms involved and I got to look at this as an overarching picture. You'll notice there are only 4 curves here, even though there are 5 columns in our Excel spreadsheet. The 2017 curve, this 4th column, is not in that picture. I did this in Excel, copied this over, put this data in Excel, and I added that one. So it's on our Canvas page as a separate spot. Now, bonds can be issued with various terms, so it's reasonable to have different bonds that all come due on the same date. As a matter of fact, click. The Wall Street Journal has an entire discussion, ignore this ad at the top here, of notes that mature at different dates. Please notice, I've got 3 different bonds whose date of maturity is November 30th, 2025. And they're very different coupons, bid prices, ask prices, and the asked yield. They're all different. So one of the things we can ask is, well, how do these affect my pricing? Clearly, there are different prices asked here. 99,236, 99,3, and 100.02. Wait a minute. That third bond, why is it priced above 100? It is at a premium. The coupon rate is 4.875, but the yield is just under 4. So that's actually a premium bond, as opposed to this one, which is a discount bond and is thus redeeming at a slightly lower rate for the coupon than the yield. Higher coupon rates raise prices, all other things being equal. Similar time to maturity should have similar yield. There are going to be lots of reasons that differentiate. Higher coupon rates and lower yield to maturity tend to go together. So if you just go to the Wall Street Journal page, there's a whole page just on bonds, both corporate and treasuries. I'm just looking at the moment at the treasury bonds. Longer term versus shorter term, notes versus bills. These are really short term, right? All of these are maturing in measures of weeks as opposed to months or years. One of the easiest ways to understand this is to pull the coupons out of the game. A zero coupon bond is exactly what it sounds like. A bond with no coupons just pays on maturity. In a very substantial way, this is like a simple interest loan or a single payment. I loaned you the money, you're going to pay it back to me in one fell swoop at the end. These are also sometimes called discount bonds, also known as discount bond, sometimes pure discount bond. But I like calling them zero coupon bonds. That's a little more visibly understandable. And most treasury bills do this. They simply pay at maturity. There's no couponing in between. Yield to maturity for a zero coupon bond is a good measure for the yield of a payment made at the same time. You'll often see yield to maturity abbreviated as YTM. Yield to maturity on a zero coupon bond is a good measure for the yield of a payment made at the same time based on the issue date of the zero coupon bond. So if I know what's going to happen for zero coupon bond, I can use it to kind of say, oh, well, then a payment due at this point or paid at this point would be the same as if I had a zero coupon bond issued on this, which means I can represent cash flows as if I'm buying and selling zero coupon bonds. If I know what's going to happen for the rates and pricings of the bonds, I can compute the present value of all the payments based on those. This gives rise to my definition of the term structure of interest rates for zero coupon bonds. Not just a general term structure of interest rates, but the one just specifically based on zero coupon bonds. Today, at the current point in time, is the set of yield numbers for zero coupon bonds of all maturity dates going forward. The set of yield rates on the zero coupon bonds of all maturity dates. All right, this is a set of numbers. RT for T bigger than 0. Where RT is the yield for a zero coupon bond maturing at time T. If I have this term structure, I can make a picture. That'll be our zero coupon bond yield curve. Now, it's interesting to me that this zero coupon bond yield curve happens to be available to us. Let me pull up our Canvas page. And in our web links section, there's this link to the Federal Reserve economic data. Fred, if I go there, I can get the zero coupon bond yield curve. I can pick terms. All of this information exists. This is what the zero coupon bond yield curve has been from 2021 through to today. So we can actually get a picture as far back as you want to go. There are an average. So this is today right here, 4.0913. It's not adjusted and it's in percentage points. I can get all this data live from the Federal Reserve right here. This is a fairly loose idea. If I really want to nail down and be more precise about term structure, I should be much more precise about what kind of securities I'm offering. Same risk class, same coupon rate, all of those things need to be held constant. And really the only thing that should change is the interest rate. Different classes, corporate bonds versus federal bonds versus state bonds versus international bonds, will all have different structure behaviors. But for the most part, this is a simplified view. Questions? Almost always, we are looking at a specific risk class at zero coupon bonds to make our lives easier. I'm going to deal with this idea the most. RT is the yield. That's got to be an annualized thing, right? I've got to do it in comparable units. Let's nail this down a little more tightly. So the yield to maturity on a zero coupon bond is called the spot rate. For that particular time of maturity. So there'll be a spot rate for 6 months. There'll be a spot rate for a year, a spot rate for 2 years, a spot rate for 9 months. It's going to depend on the time. RT will denote the annual effective spot rate. For a T-year, zero coupon bond. T-year maturity, zero coupon bond. If I'm dealing in years, that means that 6-month price is T.5. If I'm dealing in years, that 9-month price is T is 0.75. So how do I get the price for such a zero coupon bond? Price for a T-year maturity zero coupon bond. Let's make our lives easy. With a future value of 1, you will owe me 1 in T years. This is a calculation you should be able to do immediately. If I know its future value is 1, there are no coupons, what's the present value? Using compound interest. All the way back, chapters 1 and 2. The compound interest, my present value becomes my future. What do I have to do to move forward in time? I need to write down an equation here, and then we'll solve it for P. What goes on this side, right here, of this equation? I'm just doing normal compound interest.
Plus the rate,
With a little bit more.
the Long period.
Whatever my period is. Well, this is T years, right? And the rate in question is RT. Which means that my price is 1 plus RT to the minus T. Wait a minute. I know that. That's that V factor, isn't it? There's only one payment. There's no coupons, there's no intermediate behavior, but there is compound interest involved here. So I end up with a price given by my V. So this is exactly in line with our prior idea that I think of payments as being brought back to today for present value. Huh. I want to take this idea and think about what it means for a series of payments, for cash flows, for multiple payments, even if I was dealing with coupons. Oh, if I have a coupon bond, I get all the coupons and the redemption payment. A normal term structure has increasing spot rates for payments that happen further in the future. So as a collection of payments, I shouldn't have the same rate all the way through. Now, this is what's different between this idea and what we were doing last week and the week before. We have held interest rates constant all the way through our coupons. Your yield rate was the same all the way through. Your coupon rate was the same all the way through. But that's not realistic because an increasing term structure tells me that those payments further out in the future should be worth more because term rates go up. If we're in an inverted yield curve, then those term rates go down. It is very rare for us to be in a flat term structure, although those are mathematically the easiest. That's why we were doing them this whole time. Because we're just like, oh, just pick one rate, stick with it for the whole 20 years, or the whole 10 years, or the whole 30 years. That's unrealistic. But it is easy algebraically. But if I think of this as a collection of payments, I'm going to end up with a mix of all these different spot rates. The yield to maturity isn't just one number. It's a mixture of all of these rates. So yield is not just one decided on number, it's a mixture based on our expectations moving forward in the future. So let's think about what this would look like algebraically. Payments C1 through Cn due at times T1 to Tn respectively. Now, these can be positive or negative, right? If we're thinking of cash flow. But if I'm thinking of a bond, they're all payments to me, so they'd all be positive. Then my present value should be C1, 1 plus R1 to the negative T1, C2, 1 plus R2 to the negative T2, and so on up to Cn, I'm sorry, that should be R, yeah, RT, Rn to the Tn. No, RT1, RT2, up to RTN. I need to put a star next to this formula. I'm going to use it quite a bit in the next several calculations. The problem with this pickup is that I need to now know all of these spot rates to figure out what's going on. But let's think about this. I need a rate for each different term. If I'm going to get payments like we were doing with our bonds every 6 months, I need an interest rate 6 months from now, a year from now, a year and a half, 2 years, 2.5, 3 years, for however long I'm going to go. And those could be different based on our yield curve. Questions? Most traders don't sell zero coupon bonds. The Treasury does. T-bills with terms of less than 1 year are usually zero coupon bonds. But there's an interesting secondary market. I have bond. This piece of paper. Let's say it's a 10-year bond. A 10-year bond with semi-annual coupons. What I could do is I could cut that bond into pieces. And instead of thinking of it as one bond with 21 payments, right? Semi-annual coupons for 10 years and the redemption amount. That's 20 coupons and 1 redemption. That's 21 different things. I could give each one its own ID and sell them all separately. Holy crap. Each coupon and the redemption value become a separate security. They get their own ID numbers and they're all zero coupon. And that's, for the most part, the way you get at zero coupon bonds. In the US, this is the strips market. Separate trading of registered interest and principal of securities. By the way, the Treasury Direct website has a link to the strips market. Each stripped part is now tradable, sellable as a separate thing. Which basically, if you think about it, let's suppose I'm picking this number for a reason. I have a 26-year bond. I know that's an odd number. I promise there's a reason for it. 26-year bond, semi-annual coupons. How many coupon payments do I have? $26 times 2. So picture a deck of cards. My coupons are a deck of cards. Oh, by the way, the principal on the bond is the joker. So I have 53 cards. And all I do is I put an ID on each one. And instead of selling the whole deck of cards, I sell one card or two cards or three cards at a time. And I can trade them with other people. And these are now separate items. Now, maybe the ace of clubs is the coupon that is due in 6 months. I look at the spot rate for 6 months and you can tell me how much this card is worth. I look at spot rate for 3 years and I go through the deck and I find the 6 of clubs, which is due in 3 years, and we sell you that card. And then you put that card in your pocket for the next 2 years and 364 days. And at day 365 in year 3, you walk up and say, I'd like to cash this in, please. It's a zero coupon bond. You hold it until it's due, you get paid. If I find all of the pieces of my bond that have not yet been cashed in, I can reassemble and reconstitute it and then put it back into one thing. I can unstrip it. I just need to know what payments are still outstanding. So if my 26-year bond, 5 years have gone by, I need to be able to find all of the 21 years worth of outstanding payments and the redemption value. That joker is out there somewhere. And if I can buy them all back, I can turn it back into one thing. And then you'd earn coupons again. This is also sometimes called coupons and residuals, also known as coupons and residuals. Every day there are quotes and prices of strips, yields for treasuries with near and far terms. And every day, those yields are what most financial people use to say this is a risk-free investment. The reason these are considered risk-free investments is because the US guarantees its payments. So again, I'm not sure how closely you personally follow the financial news or the financial markets, but about a year ago, no, not even, less than 6 months ago, the federal government was nearing its threshold of borrowing, the debt ceiling, and president said, we need to raise the debt ceiling so we can borrow the money to spend. Because if we don't pay back our loans, we'll be in default. And if the US goes into default, we will no longer be considered the gold standard for risk-free investment. And the US has been the gold standard for risk-free investment for over 100 years. This isn't something we want to start doing. That is where we determine the spot rate from. That set of interest rates. So 99.99% of the spot rates we see are based off of how people think about payments that are coming from the US federal government. And when we actually look at the prices on the strips market on that treasury.gov webpage, that's the present value of $100. So instead of a future value of 1, we have a future value of 100. And if the maturity date is a month, then I can say, oh, I use the price per dollar as my value factor. If my price was $98 for a term of, I don't know, 2 years, then I could use 0.98 as my value for V. That's 1 over 1 plus R. So I take 1 over 0.98. And I get an interest rate of 2.04%. I know the price on a stripped piece. That's my zero coupon bond. I can use that to determine my spot rate by using the price per dollar. Payments are listed as annual rates, compounded semi-annually. Wait a minute. That means that 1 plus J squared, right? 1 plus J over 2, 1 plus J over 2 squared. Now, here's where I can say things changed. Here is a table from the Wall Street Journal that I can't find anymore. The Wall Street Journal no longer carries the strips price. But I went to several other web pages, like the Fed for strips, treasury.gov. If you go to SP Global, what's SP? Oh, Standard and Poor, SP Global, they have treasury, strips are there, and we can find a piece like this. And I can see what was bid, what was asked. Remember, that's our spread, and what the yield is at the ask price. This is on the principal. This is on the joker. This is on the coupon. Notice they're different. Coupon payments are smaller. Coupon payments are at a different behavior. The two columns represent the residual, our principal, and our coupon. Differences in yield rates are small, even though we have lots of things with the same maturity. These, by the way, are month and year, not month and day, because I was kind of confused when I got down here and I got to 36 and 39 and 41 and 47. What is May 47th? It's May of 2047. Makes more sense that way. So you'll notice these are listed in monthly periods. These are in quarters as to what comes due that quarter. Several different amounts are available as different instruments are stripped. Principal is always greater than the coupon. So you're investing a bigger portion and thus you pay more and get a lower yield. There are market implications about how liquid the capital availability is. Do I have money, cash, readily available? I can plot yields versus date. By the way, I turned this table into an Excel. It's on our Canvas page as an example, I think. Let's check. Let's make sure it's on the Canvas page as an example. If it isn't, we'll have to put it there. Go back to our Canvas page. Boink. Examples. Chapter 7. I think this is our table right here. No, that's an example. Oh, I'll have to go find our strip table. I know I did it. Now I just have to find out where I put it. Stop. No, that's my Fred yield. T-bills discounts to interest. No, that's not it either. I'll find it. I know I did it somewhere, but we have this, we can plot this, and that'll give us our term structure. So I could plot this set of yields. Now notice this appears to be a normal yield curve. Lower yields at the beginning, higher yields at the end. Lower yields at the beginning, higher yields at the end. So this looks like a normal yield curve, which makes me happy again. All right. 8/15/8/23, August 23rd. See this this little star I put right here? That's a price of $88,952 for $100 payment. Principal. And the yield rate is 1.91%. So that means each 6 months, it's half that. It says here that this was done on June 22nd, 2017. Ask price for August 15th, 2023 is 88.952. Yield 1.91%. So per period is half that. 0.0955. All right. 6 years would get me to June of 2023. 30 days in June, 31 in July, 15 in August. 15 and 31 is 45, plus the 8 days to the end of the year. Oh, I left off. I need to leave off one end date to subtract one. I get 54 days. So T is 6 plus 54 over 182.5. Why is it over 182.5? Yeah, 365 days and a half. 6 plus 54 div 182.5 is 6.295890411. I can write down all the decimal places for now. Oh, wait a minute. I made a mistake. stop, rewind. What mistake did I make? Right here. It's 6 years. But this is in terms of periods, right? Because I divided by 2. This should be 12. Periods. Because it's compounded semi-annually. Now, interestingly enough, if I do the present value of 100 at this rate, 1.00955 to the negative 12.295, let me round to 9 there. What do you get?
88.70.
But up here I have 88.952. What gives? Round off issues. The problem is round off. Realistically, 1.91% is rounded to 2 decimal places. And that's part of the problem. If I actually solve for J, 88.952 equals 101 plus J to the negative 12.2959, I can actually solve this. Point 88952, 1 plus J to the negative 12.2959. So 1 plus J is 0.88952 raised to the 1 over negative 12.2959. Well, that's a disgusting looking number, but I can do it. 0.88952 raised to the 1 over negative 12.2959. That's the 6-month rate. So let's subtract off the 1 and multiply by 2. It's not 1.91, it's 1.9133. They rounded off on the stupid table. The problem with a 1.91 with 2 decimal place rounding is I could be half a tenth of a point, half a hundredth of a point in either direction. Could be anywhere between 1.095 and 1.9149. So there's a lot of range in there. All right. What I really should do is I should get a more accurate table. A table that is much more larger in terms of the number of decimal places given per rate. I can do this. I can generate that. As we saw earlier, rates can be given to 5, 6, 7. The Fred table gave 3 decimal places. The bond table we were using back in chapter 1 gave 6 decimal places. It's going to depend on what regulatory environment requires of us. So how do I use this? This table and its rates, how do I use them to price a bond with coupons? Well, assuming it's a risk-free idea, because these are treasury prices, I'm going to make the assumption that we're still dealing with risk-free. I can go through each and every piece of the payment and bring it back to today using the rates in the table. It's going to take me longer than 3 minutes. We'll look at it on Thursday, but that's where I'll pick up. Right? So we'll do that example when we come back on Thursday. Reminder, you have a homework assignment due to me then, and I will see you all then. Have a wonderful rest of your day.